Closing agent, we talked about this a little bit earlier under general mortgage knowledge. Closing agent is a person that gathers the necessary information from the borrower, from the lender, from all parties to close the transaction. Typically, it's going to be an escrow agent or an escrow officer here on the West Coast, and on the East Coast, you would have attorneys that would typically be your closing agent. They're the ones that are going to document all the debts or the debits of the transaction and all the credits of the transaction. This is what's going to show up on either the HUD-1 or the closing disclosure, depending on what type of transaction you're doing. And they decide what credits are being applied, what debits are being taken out, what is the balance that the buyer or the seller have to come in with. They calculate the various prorations, they complete the HUD-1 or the closing disclosure, and they compare the good faith estimate to the HUD-1 or, again, the loan estimate to the loan closing disclosure, depending on what type of transaction you are doing. Title insurance is commonly referred to as an ALTA policy. That stands for American Land Title Association. This is, again, insurance that is given on the title or legal ownership of the property. It happens all the time where somebody sells a house and the new buyer owns it, but some past person that was never paid what they were supposed to be paid for that house because they had an equitable interest and it just got missed, comes back and says, hey, this is my house, or I have some, interest in it. Well, that's not your fault. That's not your responsibility, right? Those are the kind of things that the title company or the title insurance pays out on for discrepancies in ownership or legal interest. You don't want to be bothered with that after you bought the house. That's what title insurance is for. Again, the seller is expected to deliver marketable title, but sometimes things come up from years ago that you never even knew about. Title does a public record search to see the quality of the title. Chain of title is that clear, unbroken chain of ownership from day one, from the first time it was ever sold to today. A cloud on title is a gap in the chain of title. Where is there a missing link? Okay. Sometimes there can be a lawsuit to quiet title. This will close any missing links and can remove all those clouds. So again, if you have a missing link in the chain, we need to find out who is the legal owner during that time frame. Why is it missing? And is there anything owed to them? How are we going to clear this out? Title insurance protects the lenders against the loss due to a dispute of defect or defect in title. Again, if something's missing, lender does not want to have to pay out of pocket. That's what they have title insurance for. Now, origination fee, we talked about this earlier. This is typically what I, the loan officer, am charging. I have to charge all people the same amount, otherwise I could be discriminating. And this is what my fee is to actually do the loan for you. The lender's going to give you the money, but I have a fee for my service to help you, get this loan. It generally covers administration costs and my service fee and the lender fees and things like that. Sometimes it's called a service fee. Usually it's based on a percentage of the loan amount. Sometimes it's a flat fee. Sometimes it's a percentage of the loan amount. That's determined from broker to broker, lender to lender, banker to banker, in an individual agreement with their loan officers. All right. Lots of fees can be charged. They can be paid by the seller, they can be paid by the buyer, or they can be paid as a credit from the yield spread premium. Again, RESPA prohibits any fee that was not disclosed on the good faith estimate or the loan estimate. If it wasn't disclosed, it has to be redisclosed correctly, or you cannot charge that fee. These are all your typical main fees that you would see in a loan transaction: application fee, credit report, appraisal, prelim, recording fees, title fees, escrow fees, all very common. Promissory note. Promissory note is a promise to repay. This is your instrument, your finance instrument that says I promise to repay, and it usually includes all of these items: the date, who the parties are, who the lender is, who the responsible payment is expected to be paid from, and the terms of the agreement. A trust deed we mentioned before. It's a three-party instrument that secures the loan against a piece of collateral. This is your security instrument. Three parties. Then you also have something called a mortgage, which we're going to cover here in a second. This gives borrower the possession and equitable title. It's your home. Title is vested to the borrower, And it's a little bit different on the mortgages, so we'll cover that in just a moment. The trustee, who's that disinterested third party, will file a non-judicial foreclosure in the event of a default. A mortgage is also a security instrument. These usually go by states, depending on what type of state, a mortgage state or a trustee state. Creates a voluntary lien on the property. It gives the lender the right to sell the property in the event the borrower defaults, but they do have to go through a judicial foreclosure. And what this is called is hypothecation. You have a hypothecation agreement, or basically you have hypothecated the property, the piece of collateral. You hypothecate, which means to pledge. You pledge this house as collateral to get this loan. All right, so if you hear the term hypothecate, it means you are in a mortgage state. Funding of the loan. Funding of the loan is approved by the lender. The lender or the underwriter give the final okay to close. Funds are dispersed. The lender gives the money to the escrow company. The escrow company sends out the money to each individual party that had fees on that loan. If you've got a loan that is a owner-occupied refinance, you have a 3-day right of rescission. That is because of the Truth in Lending Act. Interest per diem. This is how or what closing agents will do to determine how much interest you owe at the time of closing. Interest or mortgages payments are paid in arrears. You accrue the interest first and you pay it later. So let's say it was October. I am closing the loan on October 15th. Okay, my first payment is not going to be due until December because I'm going to accrue the interest in November. My payment's due on December 1st. But I do need to pay interest for October 15th through October 30th, the time, or 31st, the time frame that I owned the property. Well, you don't have a November payment, so how are you going to pay that? Well, that's what's going to be paid at closing. Let me show you a quick example. This is how you calculate per diem interest. All right, let's say for easy math, again, $100,000 loan amount. I'm closing on October 15th. There are 31 days in October. All right, my interest rate is, let's say, just again for easy math, 6%. 100,000 times 6% is going to be $6,000. That $6,000 you would divide by 365 days. And you know me, no way on God's green earth I'm doing this math in my head. So you take $6,000, divide it by 365, that's $16.44 a day. I need to collect from now, the day I close, to the last day of the month. Now, the 15th counts. So 15th through the 30th would be 16 days if I count the 15th, and an additional day for the 31st, right? So 15, 16, 17, 18, 19, 20, 21, 22, 23, 24, 25, 26, 27, 28, 29, 30, 31. So again, 17 days of interest. So $16 per day times 17 days would equal $279.45. So what this means is you're going to have an additional closing cost of $279.45 if you close on the 15th. If you close on the 20th, you're going to have less interest per diem. If you close earlier in the month, you're going to have more interest to pay at closing because you had more days of the month that you had to count for that interest. Okay. All right, so that's how you calculate. And that leads us to our ethics section. Now remember, a lot of ethics, this is going to be a quick review on your laws, because a lot of ethics is about, do you know and understand when you violated a law or you're doing something just a little outside the scope that may not be in the best interest of the borrower. All right, now our last two sections are going to go pretty quick. Again, this part in ethics is a bit of a review, some new things like fraud and, misrepresentation and things like that. So a few things you won't have heard before. And the last section is going to be the uniform state test. And so we're going to get into that here in just a minute. But for right now, let's talk about ethics. Civil Rights Act, discrimination. Sometimes it's legal, sometimes it's not, but all in all, it's just an unethical practice. To discriminate against people just because of race makes no sense, especially in the mortgage industry. You can make your payments or you can't. Again, you heard me talk earlier about the Civil Rights Act of 1866. This law is always going to be about race. Fair housing, again, prohibited practices. Now, you heard me talk earlier about the Fair Housing Act, where there were 3 specific things under the Fair Housing Act you absolutely need to know about. They will be on your exam. Prohibited practices is things like refusing to make a loan based on a discriminatory reason, or imposing different terms based on a discriminatory reason. Now, one prohibited practice under the Fair Housing Act is blockbusting. Blockbusting is an old practice. You don't really hear about it much anymore, but it would be where, let's say, a real estate agent and a loan officer team up together to try and get more business. So they go to this predominantly white neighborhood and knock on doors and they say, hey, Mr. Homeowner, you might want to consider selling your home because this minority just moved in down the street. We're expecting values to go down. Now, there's no truth to that whatsoever, but the real estate agent and loan officer would team up to do this so that they could create more sales and basically create more income for themselves. Horribly unscrupulous practice, right? Well, it was done once upon a time. I mean, it still is done a little bit today, but it's not quite as obvious. So the way I remember this, it's somebody coming in and trying to break apart the block, right? Get people to panic sell so that they can make more commissions. So block busting is where you're trying to break or bust apart the block, and that's when somebody goes in and tries to create panic selling because people think that their values are going to down based on some discriminatory reason. The next thing is called steering. Steering is twofold. Number one, if you've got a borrower who fits the profile of a neighborhood, I don't care what that means. It could be a Hispanic person being steered or encouraged to buy a property in a certain area because their race or ethnicity is common in that area. Or maybe there's the name of a Spanish street or something like that. And so a loan officer or a real estate agent would encourage or only show someone the properties that are in the area that they fit the profile. So think of it like steering your car. You turn the car this way or the wheel this way and the car goes that way and vice versa, it goes that way. You would steer the borrower into these areas where you feel that they fit the profile. And the last but not least is redlining. Redlining is the refusal to do a loan in a specific area, regardless of whether or not somebody qualifies. Here's a quick example. All right, I'm a terrible artist, so humor me here. Okay, it's supposed to be California. It looks like a big giant sock. Anyway, so let's say that there was a lender and they had this area on a map. Even give you a more literal example. They have an area on a map that has a circle with a line through it. We don't lend here. You could be Warren Buffett with all the money and all the assets in the world. He just wants to get a small loan for a tax deduction, but he wants to buy it in this neighborhood. Bank says, nope, we don't lend there. For whatever reason, if it's a racial thing or a ethnic thing or values are declining in that area, no, cannot be done. If you meet the requirements of the loan, you have enough down payment, enough income, enough assets, low debt ratios, job stability, blah, blah, blah. No matter what, you cannot get a loan here because we don't lend there. That is redlining under the Fair Housing Act. Don't do it. Very bad practice. But literally back in the day, maps would be on the wall of mortgage offices with red lines and circles through it saying we don't lend here. And again, that is steering and absolutely a prohibited practice. Under the Fair Housing Act, Anytime you are advertising, you have to utilize the equal housing lender slogan if it's a broadcast advertisement, the equal housing poster if there is a physical branch location, and display the equal housing logo on all printed promotional or, again, marketing advertising materials. Now, fraud. Fraud's a big deal. Fraud is a big part of why the mortgage industry crashed and burned in 2008. That's why a lot of people were displaced, lost their homes, bankruptcies, foreclosures, unprecedented rates. Now, fraud is the misrepresentation or concealment of a material fact. Now, that fraud could have been done intentionally, which is actual fraud, knowing darn good and well your borrower doesn't make $10,000 a month, they make $5,000 a month, but you lied so your borrower could get the house they wanted and you could make the commission. Then there's also constructive fraud. I really hate that term because it makes it sound like it was something constructive that was done, like something good was going to come of this, but it didn't. Constructive fraud means unintentional, or it was a result of carelessness or neglect. Now, your consequences are less if it is constructive fraud because you didn't mean to do fraud, you missed a detail, you didn't connect the dots right, and at the end of the day, you did fraud, but that wasn't your intention. It is still fraud. You'll probably get fined and a slap on the hand or something, but you will need to explain it and there will be consequences. Actual fraud, you can end up in jail for that. Unless you look good in orange, I would not go down that path. Mortgage fraud, any misrepresentation or concealment used to obtain a mortgage loan. We have something called straw borrowers or straw buyers. Actually, that will show up somewhere in here. I'll show you in a second. But straw buyers is when I want a house and I don't qualify for the house. So my brother says he's going to buy the house, even though he's not going to live there. He's not going to make the payments. I am. But I don't qualify. He does. He would be a straw buyer, somebody pretending to be the owner and buyer of this house, but not really. Okay? Now, negligence, we talked about that. Unintentional breach of legal duty. Again, not doing what you're supposed to be doing. Fraud, actual and constructive. There are two categories of mortgage fraud. There is fraud for profit and fraud for property. Fraud for profit is when someone who's an industry insider commits the fraud so that they can earn income or profit. They get their commission. Fraud for property is typically done by a borrower, and the borrower does it so that they can obtain the property, something that they fraudulated because they couldn't qualify on their own, so they fraudulated some of the documentation so that they could qualify. And then there are three methods of mortgage fraud. Material misrepresentation. You doctor or alter documents. Material misstatement. You say something knowing that it is not true, or omissions. All right. Some people think not telling you is different than lying. Well, an omission is an omission, regardless if it's unintentional or intentional. You omitted a fact, regardless of whether or not you knew about it, that is still fraud. Anybody can be a fraud perpetrator. Borrowers can do it. Lenders or mortgage loan officers can do it. This is all the different ways that they can do it. Like I said a moment ago, straw borrowers or straw buyers. Appraisers by inflating the values, or attorneys or escrow agents by making false payoff demands or making it look like a certain party is receiving a fee when they're not. It's going to someone else. Accountants falsifying tax returns. It used to happen all the time. Title companies, they would show a fake deed or lien on the property. They could inflate the fees and kick them back to the loan officer or the mortgage company. They could create false payoffs, lots of different ways that title companies can engage. Government workers, you've got a good buddy that works down at the county recorder's office, recorded deed, next day unrecorded. Real estate agents, there's lots of different ways they can do fraud. They can find straw buyers for a property. They can artificially inflate the values by having a buddy buy this house to make it look like it's sold for more, so that the house that they're really trying to sell down the street is now appraised for higher. Lots of different ways that real estate agents can be a part of the process. Rehabbers or FSBO, F-S-B-O, that is for sale by owner. A lot more opportunity for a for sale by owner because you don't require inspections. A lot of times what would happen is somebody could buy a house as a fixer-upper, use really sub-quality materials. Let's say that there was water damage on the floor, so they ripped up all the old flooring and found a lot of damage underneath, so they just slapped down the cheapest particle board that they could find just to make the floor last a few months until the right amount of weight got on it or it was weakened and it would fall through. That's one way that FSBOs or flippers can create fraud, using subpar materials but keeping it pretty on the surface. It'd be like using, again, press board or particle board underneath the flooring as the subfloor, but then putting a nice pretty coat of tile over it so you don't really know what the poor quality is. Lots of different mortgage fraud schemes. An heir loan. It's doing a loan where you think there's a house, but there is no house. Again, the appraiser is usually in cahoots. They take a picture of another home, but say it is this home, match it all up on the plat map so it looks like it makes sense. There was no home there. There was a loan done on air because there was no property there, but you and the appraiser made it look like there was. A deed scam. Forging a seller's signature, selling that property off to another party. That new party comes up, knocks on the door. What are you doing in my house? The homeowner says, what are you talking about? This is my house. No, it's not. You sold it to me. No, I didn't. Let's go find an attorney. Double sold loans. A lot harder for this to happen today, but this would be where somebody would do a loan and sell it to two investors, telling them that they were the only one, receiving the checks on both of them, and then going and living in the Bahamas or Barbados or someplace where you can never be found. Unrecorded or silent second is a fraud scheme because the buyer gets a second mortgage, typically from a seller, which would be called a seller carryback, without informing the lender. So it's not recorded, it is an agreement. So really there's more liens and encumbrances on the property, but the lender doesn't necessarily know about them. All right, illegal flipping. This is where a property is purchased, resold for an increase when there's no justifiable reason for the increase. You buy a property, you fix it up, you sell it, fine. But what happens if you buy a property and 2 months later sell it and you didn't do a thing to it? Well, yeah, that could just be the capitalistic, opportunistic way, but there has to be a justifiable reason for the increase in the value. And likelihood is, unless you bought it as a foreclosure sale, a short sale and got a really great smoking deal, or had some justifiable reason for buying it for less, then chances are it's going to be considered illegal flipping. All right. Generally, too, it will include a series of false sales and resales, or a series of sales and resales to make it look like it's growing in value from one sale to the next. Oftentimes, illegal flipping requires the collusion of more than one party. The appraiser is in cahoots with the seller, who's in cahoots with the broker, the lender, or the real estate agent. A lot of times, this is more prevalent or more common in mixed value areas. Every state typically has one area in their state where you cross the street and go a block, it's one neighborhood. You cross the street and go another block, it's entirely different. Well, in those mixed value areas, if the lender's not familiar with the area, they don't have a local branch there, they very well may not know that across the street, even though it looks like a true comparable, isn't, because it's an entire neighborhood change. The use of out-of-town entities specifically for that purpose. They don't have an office locally here. They're not going to know that across the street and down the block is a lower or a higher end neighborhood. Now, FHA, in order to try and prevent illegal flipping and artificial inflation, had created a requirement that you had to wait at least 90 days before you could sell a property for a higher amount than what you paid for it. Now, if you bought the property, fixed it up, those improvements are considered into the resale price. Anything above and beyond that has to be justified or explained, or you may not be able to sell it until you wait the 90-day mark. After that, you are limited on how much percentage over what you purchased and put into it, how much the property can be sold for. Most of the times, appraisers are required to list on the appraisal who has owned it for the last 3 years. Really, we're looking for non-arm's length transactions. Was there a series of quick sales and resales? it's okay to do, but it's going to be looked at closely to make sure there is no illegal flipping going on. Detection and prevention. In order to try and detect and prevent illegal flipping or any fraud from occurring, the FBI, the Federal Bureau of Investigation, has what's called a Suspicious Activity Report, or a SAR, S-A-R, Suspicious Activity Report. And if you suspect some weird transactions going on, or you feel like you're working with a really shady, real estate agent, you can file a SAR. Or if there's any other weird or suspicious or unusual activity with a person in the industry, you can actually file a SAR, a Suspicious Activity Report, and the FBI will typically research and investigate it. It may not be an open investigation. They can send over a secret shopper and try and lure them into doing something unscrupulous or illegal or unethical. So the SARs are filed, and they're usually filed by a financial institution, but an individual would easily be able to do this as well. Again, there's also private subscription services. With those, again, there's also things like blogs and online resources where you can research what, if there's any reports about this person doing anything unethical in other areas, if there's a history or a pattern of this behavior. Oftentimes, fraud schemes catch on, so you can go online and just stay up to date about what type of schemes are being done, so you can keep your borrowers aware of what type of schemes or scams are about in the marketplace, so that they can keep their eyes and ears open to make sure it's not happening to them. Predatory lending. Predatory lending, not illegal, very unethical. Charging someone more because you can. Refinancing someone over and over again because they're elderly and they don't really understand what you're doing and how it's hurting them. So these are really any loans that can take advantage of an ill-informed consumer. That, again, could be charging high fees, telling them 22 reasons from Sunday why the fees are higher than what they were expecting them to be, misrepresenting the loan terms, calling it a fixed when it's really an ARM. Other prohibited acts, like telling them you are paying off their taxes because they were late on them, or putting them back into the same loan they just got out of because you want to churn them or refinance them again in a certain period of time. Really, it's targeting the borrower who has little knowledge or defense. They don't have family members or kids or somebody that's going to be looking out for them. The goal, with the intention of refinancing the borrower over and over again, to strip it of its equity so you continue to make commission. All right, there is a statement on subprime mortgage lending that was created in 2007, making loans on predominantly on the foreclosure or liquidation value rather than the borrower's ability to repay. What does that mean? Let's say you do a loan based on a low loan to value because you know if the borrower doesn't make the payments, you easily can foreclose, sell it, and still make a profit. Doesn't sound that harmful, right? But if you know when you're doing the loan, the borrower cannot afford those payments, then yeah, that's predatory. You're taking advantage of the borrower knowing they can't make their payments with the full intention of foreclosing and either taking the house back and living in it yourself or selling it on a foreclosure basis and getting your money back at a later date. Inducing borrowers to sell or to intentionally refinance, so again, you make commission. Engaging in fraud or deception to conceal the true nature of the loan obligation, again, from an unsuspecting or an unsophisticated borrower. All right, a lot of times these things are not necessarily predatory. If the borrower benefits from the transaction, they get cash out, they can afford the payments, it helps them with their lifestyle, it saves them money every month. There has to be tangible benefit to the borrower. If there is, then yeah, you're going to be okay. But it's when there's no benefit to the borrower and only benefit to you that you're going to find yourself into a little bit of trouble. Lots of different predatory lending practices, charging excessive fees, charging high prepayment penalties, extreme lending, lending to someone you know has a high amount of debt compared to their income. Equity skimming, doing loans to a borrower, knowing they are not going to be able to pay, so you can refinance them again and again and again until all of their equity is gone. Loan flipping, again, refinancing people over and over again. This is also called churning, so that you can build fees in and still make your commission even though they didn't have anything out of pocket. There's lots of different indicators. You can read this on your own. But again, if it seems suspicious to you, it probably is. Now, maybe in the end, it was just a miscommunication, a misunderstanding, or what have you. But steering borrowers into a high-rate program, falsely identifying loans, falsifying documents, forging signatures, requiring credit insurance, failing to report good payment history. All of these things are predatory. It's intended to take advantage of the consumer. And CFPB is all about protecting the consumer. All right, and as I said, that was going to be a pretty quick section. One more section to go, and you are finally done with your test prep video. All right, last but not least, the Uniform State Test. This is 20% of your exam. It is primarily on the SAFE Act, the Secure and Fair Enforcement Act. I highly recommend you aim to get 100% in this category. Not hard to do. I missed one question in this category, and it's only because I was going too fast and I didn't read the question thoroughly. I was really looking for that 100%. If you get 100% in this category, it can really offset any other area that you are weak in. Really strive to get 100% here. It can really offset the areas that you're weaker in. All right, the Uniform State Test, as I said before, is a lot about the SAFE Act. It's adhering to the SAFE Act. So basically when it comes to the Uniform State Test, it says that different organizations within each state are responsible for enforcing the laws under the SAFE Act. So that could be Department of Financial Institutions or some mortgage regulatory authority. State laws and regulation definitions apply in all states. You have to meet the federal laws, and then some states have additional laws that you have to meet as well. They will give, the states are the ones that again are giving you your license. So they have licensing law and regulation and compliance items that you have to adhere to. And you have to do this again on two levels. You have to adhere to the federal laws and the state laws in order to be a mortgage loan originator. So again, the Department of Financial Institutions or Mortgage Regulatory Commission, they are the regulatory authority. They're the ones issuing the licenses and providing the regulations and enforcing them. And they're the ones that have the responsibilities, but there's certain limitations to what they can and cannot do. Department of Financial Institutions, as a regulatory authority, they're going to create the system and supervise and enforce the mortgage laws or the mortgage lending industry. A Department of Financial Institution or the regulatory authority can deny, suspend, condition, or revoke a license. They can examine, investigate, or conduct enforcement actions. This here is done again by the states. The NMLS doesn't take your license away. The CFPB doesn't take your license away. The state regulatory authority is the one who takes your license away. They issue the license, they suspend the license. The licensing comes from the states. They can do all these things, subpoena witnesses and get documents. They can enter orders, including cease and desist orders. They can order restitution and monetary penalties. They can order the removal and ban individuals from an office and from future employment in any mortgage or financial institution. The commissioner has the administrative authority to administer, enhance, protect, enforce, and interpret all of the SAFE Act. They can also promulgate the rules and regulations when it comes to implementing the SAFE Act, and they can implement even more strict regulations in their state as well. Now here's your definitions. Most of them are self-explanatory, so make sure you review these. Again, aim for 100% here. It's really not a tough section at all. Depository institution. Do I have to explain that? I hope not. But a depository institution is an organization that you give money to, they hold on to it for deposits, and you can pull your money from it. Checking or savings account, that would be a depository institution. A federal banking agency is someone under the, or an organization or a company under the Board of Governors of the Federal Reserve System, the Comptroller of the Currency, the Office of Thrift Supervision, National Credit Union Administration, and the Federal Deposit Insurance Corporation. Those are your federal banking agencies. So it's a company or a corporation that their regulating authority is one of these guys. That would make them a federal banking agency. Immediate family member. Why is this important? If you are doing a loan for an immediate family member, you got to make sure that you have your proper disclosures. An immediate family member in the mortgage industry is considered spouse, child, sibling, parent, grandparent, or grandchild, including step and adoptive relationships. You are not supposed to do a loan for an immediate family member, but of course, why wouldn't you? You want to make sure that they're protected, right? So it's okay to do it. You just have to make sure that you are treating them the same as what you would treat or looking out for them as you would any other borrower. Individual is a natural person. A loan processor or underwriter is somebody who works for a mortgage banker that processes or underwrites the loan. That individual may or may not need to have their mortgage license. A loan processor and underwriter is typically one that does clerical or support duties. They underwrite the file, but they don't normally have communications with the borrower. Representations to the public. If you make a representation to the public that you do any of these activities, like taking a loan application or quoting rates or terms of a loan, then you have to have a license. But if you do if you're an individual engaging in solely as a loan processor or an underwriter, you will not represent to the public through any of these means: advertising, business cards, stationery, brochures, any advertising or marketing opportunity, excuse me, all right, any of those items that you are marketing or advertising your services, you cannot represent to the public that you do loan applications or represent the terms of a loan, okay, through any channel of basic advertising. Each individual can or will perform any activities of the mortgage loan originator must have a license. If you're simply clerical, no license is required. If you represent to the public that you do loans or represent terms or discuss rates or anything like that, you have to have a license. A mortgage loan originator basically takes a residential loan application or offers or negotiates the terms of a loan. If you are working for a non-federal depository institution, you must have a license. If you're a W-2 wage earner under a federal depository, well, that doesn't even have to be federal, it could be state, a depository institution, then you do not have to have a license. All right, so what these people will do from a mortgage loan originator standpoint, basically you are assisting or helping the borrower apply for a loan that benefits them in some way, benefits the borrower, not you. All right, again, you do not have to have a license and you're not considered a mortgage loan originator if you do purely administrative or clerical tasks, if you have a licensed real estate broker activity, means you're selling real estate but not engaging in any part of the loan. If you extend credit on timeshares because you're only buying a portion of the property, not all of it. And again, loan processors and underwriters who do not represent to the public that they take loan applications or negotiate terms of a loan. Real estate broker activity is one that provides real estate brokerage services to the public. Nationwide Mortgage Licensing System and Registry, that's the NMLS. They're the overseeing agency for mortgage loan originator licensing. Non-traditional mortgage product, any loan other than a 30-year fixed loan. Person, really? On the exam there is, what is the definition of a person? Really? Person. The term person means a natural person, corporation, company, limited liability company, partnership, or association. So a person isn't necessarily a human, it could be an entity as well. Registered mortgage loan originator, these are your folks that work for a depository institution. Right? They don't have to have a license. They do have to register with the NMLS, have a background check done, have a credit report check done, but they do not have to go through testing or education requirements. Residential mortgage loan, a loan that is done on a residential piece of property. Just so you know, when a property is 5 units or more, that is considered a commercial property. If you have an apartment complex that has 10 units in it, but they're residential, right? You're living in it as a residence, that should be a residential mortgage loan. Wrong. There's more than 5 units, so that would be a commercial loan. Residential real estate, again, a real estate that is used for the purpose of living in. Unique identifier, that's your NMLS ID number. It's referred to as a unique identifier number, and it is assigned by the NMLS. It will stay with you wherever you go. Now, license law and regulation. Who's required to be licensed? What are the qualifications to be licensed or to get a license? What are the grounds for denying a license? And what do you have to do to maintain your license? Well, person who has to obtain a license. I feel like I've said this repeatedly. If you are not working for a depository institution, and in any way, shape, or form, if you represent the terms of a loan, you take a loan application or discuss rates or terms of a loan or loan product, you have to have a license if you do not work for a depository institution under a W-2. Again, loan processors and underwriters, if they are paid by a 1099, like a contract processor or a contract underwriter, then they do have to have a license because they're not an employee of the company. The company can't take responsibility for them. Who does not need to obtain a license? This one here is why I was telling you what the definition of an immediate family member was, okay? Parent, child, spouse, grandparent, grandchild, brother, sister, okay? Those are immediate family members. Why do you need to know that? Well, if I am an individual who offers or negotiates terms of a loan on behalf of an immediate family member of the individual, I do not need to have a license. However, if you do this for anybody else other than an immediate family member, you do have to have a license. Anybody who offers or negotiates the terms of a loan secured by a dwelling that served as that individual's residence, me representing myself on my own loan, I don't have to have a license to do that. A licensed attorney, but there's a little bit of a caveat here. Let's say I'm an attorney, I'm working on somebody's divorce. It comes up in that conversation that somebody's keeping the house. They've got to buy out the other party. The attorney knows how to do loans. They've done many in the past. They don't represent it out in public. They don't publicize that they do this on a regular basis. They don't, by all means, do this. It's just an occasional, sometimes I do it, but not on a regular basis by any means. That attorney can represent that person to do their loan and not be licensed. But again, it is limited to attorneys. Again, qualifying. What's it take to get a license? Background check. You have to have fingerprints and a criminal background check done. You have to list out your personal history and experience. You have to authorize an independent credit report to be pulled. Never have had a mortgage loan originator license revoked in any jurisdiction whatsoever. And you could not have been convicted of a felony of any kind in the last 7 years. And if you've ever been convicted of a financial felony, you will never get your mortgage license. And that would be things like, again, fraud, dishonesty, embezzlement, money laundering, things of that nature. You have to exhibit character and fitness. You got to be in really good physical shape in order to be a mortgage loan originator. Totally kidding, of course. As you can tell by my very wimpy muscles, you have to show fitness in the industry. Do you have any history of being fired for, again, I don't know, stealing money out of a cash register? Yeah, if you were prosecuted for that, even if it wasn't a felony, that's showing poor character. It's probably going to be on your record somewhere, and yeah, that's going to prevent you from getting your license. You have to operate honestly, fairly, and efficiently. When you get your mortgage loan originator license, you have to sign an agreement basically saying that you're going to adhere to all the laws and regulations of the federal and the state government, and you're going to let them know if you have some violation, if you do something wrong or something along those lines. Also, you can't show lack of financial responsibility yourself. So things like current outstanding judgments, the outstanding judgments, the foreclosures, and a serious pattern of delinquent debts, not going to stop you from getting your mortgage loan originator license. The only thing I've ever seen stop someone from getting their license is a current outstanding tax or government lien. That is the only thing I've seen people be denied for, and they have to be pretty severe and not in a payment plan. So anything other than that, BKs, foreclosures, you'll have to explain it, but it won't prevent you from getting your license, but it is going to be looked at. You might also be given like a, what's one of those licenses, I can't think of what the name is, where conditional. You might be given conditional approval, where you're going to have like some supervisory things done, report to somebody else who's going to kind of like make statements on you and watch over you just to make sure you're on the up and up. We talked about pre-licensing education before. You have to take 20 hours of pre-licensing education. Some states require more, so make sure you know and understand what states are required. 3 hours of your class has to be federal laws. 3 hours of your class has to be ethics. 2 hours has to be non-traditional mortgage products, and 12 hours is elective, but sometimes the state say in this elective has to be state law or other state regulations. Again, states can impose their own requirements as well. On the exam, 25% is federal laws, 20% is general mortgage knowledge, 20% is mortgage loan originator activities, 15% is ethics, and again, about 20% is uniform state test. You may also have a separate state exam. Let me say this again. All national exams include the uniform state test. Does not matter what state you're in. A state that you are in may require an additional state-specific exam, but all exams will have the uniform state section in it. Even if they have a separate state exam, the state or the uniform state test is still going to be on your national. A lot of people skip over this section and go, oh my God, I failed. I didn't think I had to study that because I thought it was not on my exam because I have a state test. No. Every state has the uniform state test and may have an additional separate state exam as well. If you fail your exam 3 times, you cannot take it again for 12 months, and you may be required to take pre-licensing education again. When you are going to renew your license, you have to take 8 hours at a minimum. Some states will require more of that 8 hours. 3 hours is federal laws, 2 hours is ethics, 2 hours is non-traditional mortgage products, and 1 elective hour. Some states have more hours that they require, and others say that elective must be state content. You do not get credit for the same CE class each year. You have to take a different course with a different course number and course material. If you let your license lapse for more than 5 years, you will be required to take your exams again. You may not be required to take pre-licensing education, but some states will require that. So make sure you do not let your license lapse for more than 5 years. If you let it lapse, say for 3 years, and now you decide you want to renew it, that's okay, you can do that. You will have to make up the 3 years of continued education that you missed. Actually, that's not true. If you didn't use your license for 2 years and in the 3rd year you want to renew, you have to take continued education for that year and pay the renewal dues, and then you can reinstate your license, but you don't have to make the past 2 years up. But some states will require that you do, actually. Now, net worth, surety bond, or state fund requirement. In order to become a mortgage loan originator, you have to meet 1 of 3 requirements. You personally must have a net worth that is set by the state. Some states say it's $10,000, some states say it's $25,000. If you don't meet the net worth requirement, then you can get a surety bond that covers that state amount. If you don't have a surety bond, or if your company provides the surety bond on your behalf, that is fine as well. If you don't have the net worth and you don't want to get a surety bond, last option is to pay into a state fund. Some states have them, some states don't. If they don't have this, you must do one of those two. But again, the company can have a bond that covers all their loan officers. All right, again, they can all these requirements can be met by the employing company. You have the right, if the NMLS or the state turns down your request for a license, turns down your application, they deny it. You have the right to, number one, ask the grounds in which the termination was given or the denial was given, and you have the right to challenge it. You submit a letter of explanation, show documents, show that something was wrongfully submitted, false accusations, things like that. Whatever it was, you have the right to challenge that process. Every state is required to allow for the challenge to occur. Now, in order to stay compliant, certain things you're going to have to do. There are certain things you are prohibited from doing, certain things you need to do, and you always have to maintain the advertising regulations. Prohibited acts and practices. It's prohibited for any party to the mortgage transaction to do any of these items. You're going to laugh when you see them. Directly or indirectly employ any scheme, device, or artifice to defraud or mislead borrowers or lenders, or to defraud any person. I think we all know that that would be prohibited, but it's kind of sad that in our industry, we have to actually tell you that, okay? To engage in any unfair or deceptive practice, to obtain property by fraud or misrepresentation, to solicit or enter into a contract that provides in substance that the person or individual can earn a fee through a best effort. Oh, Mr. Borrower, I did everything I could to get you that home loan. I'm sorry, you just don't qualify anywhere. I'm sorry, you just don't make anything on that. This is a commissioned business. If you get an hourly wage or a salary at your company, that's great for you, but you cannot charge somebody for a best effort attempt at getting them a mortgage loan. All right, conduct any business without holding a valid license. This will have serious consequences if you do it. You cannot fail to make disclosures that are required by law. You cannot fail to give them to the consumer. You cannot fail to comply with the rules of any state or federal law. You cannot make any false or deceptive statements or representations. You cannot negligently make any false statement or knowingly and willingly make an omission of a material fact. Cannot make a payment, threat, or promise, so on and so forth, to influence the judgment of a person. You can't bribe them or threaten them to make them do what you want them to do. Cannot make a payment, threat, or promise directly or indirectly to influence the judgment of an appraiser. You cannot cause or require a borrower to obtain property insurance coverage in the amount that exceeds the cost of improvements as established by a property insurer. I do know a lot of mortgage companies, lenders, that require the insurance company to insure the loan. That is not allowed by federal and state law. You can only be required to insure the amount of the costs to rebuild. Okay, you cannot fail to truthfully account for monies belonging to a party in a residential mortgage loan transaction. Enforcement. What can your state agency do if they catch you doing anything you're not supposed to? Deny, suspend, revoke, condition, or decline your license. They can deny, suspend, revoke, condition, or decline to renew a license. They can order restitutions, impose fines, issue orders or directives like a cease and desist order. They can order or direct affirmative action if necessary. You know what they cannot do? They cannot impose a prison term. That must be done through a court of law, through a judge. Penalties for any violation of the SAFE Act can be as much as $25,000. The commissioner has the right to access your information. They can come into your office, sit down at your computer, and take everything off of it that they choose. They can look through your files, through your shred bin. They have right to get access to all of your information. They have the right to investigate, examine, or subpoena your files. They have the right to review your books and records. They have the right to control reports and other information and require you to submit reports. Now, a mortgage call report, or an MCR, some states require it, some states don't. It's your job to know whether or not your state requirements. You can get it on the NMLS website. Does your state require an MCR? Go to this website, or you can just go to the NMLS's website and type in mortgage call report. It will tell you when it comes time to renew or to file this report whether or not your state requires it. Some states require companies to submit their application and origination activities on a quarterly basis. It's your job to know what your state requires. Predatory lending indicators, which actually doesn't apply here, those are just things, again, to always be aware of. Well, that's it, folks. Thank you and congratulations. You've reached the end of your test preparation video course presented by loanofficerschool.com. I highly encourage you to check out our website. If you've not taken your 20 hours of pre-licensing education, then make sure you go and sign up for a live webinar, a live in-person class, or a self-study course. And be sure to always check us out for your continued education and also just your mortgage loan originator education and training. We do things like help you be a competent and confident loan originator in all aspects of the mortgage loan originator industry. So if you ever need help, guidance, direction, that's what we're here to provide you with. Thanks so much for your time. Good luck on passing your exam.